Welcome to this Nedbank Financial Markets educational series, proudly brought to you by our online share trading division. Learning about trading and investing is essential for every client, as this will equip you to make more informed personal trading and investing decisions. In this educational series, we will discuss the concept of a trader's toolkit. Please note that this session is on both a beginner and intermediate level. Before we start, please refer to our disclaimer. In summary, you cannot regard this session as any trading or investment advice, as it is provided for educational purposes only. Let us commence the session. Let's start by defining what is meant by a toolkit. A toolkit is a set of adaptable guidelines or suggestions to get something done. A trading toolkit is a systemic methodology used for buying and selling securities like shares in the financial markets. It is based on predefined rules and criteria used when making trading decisions. A trading toolkit may be complex or simple and involves considerations such as trading style, technical indicators, industry sector, level of portfolio diversification, time horizon or holding period, risk tolerance, leverage, tax considerations, and so forth. The key to a successful trading toolkit is that the guidelines are set using objective data and analysis and are adhered to diligently. In order to keep it relevant, a trading toolkit should be re-evaluated and tweaked periodically as market conditions or individual goals change. Our goal when we trade is to make money in various markets. These markets can either move up, down, or sideways. Our mission is to be able to make money in each of these movements. You will need to start building a trade portfolio that reflects your market opinion, which we will also call market bias. To start, classify your opinion in three broad market bias categories. The first is a bullish bias. This is when prices appreciate over time, demand outweighs supply, and price movement displays higher highs and higher lows. Secondly, there's the bearish bias. This is when prices depreciate over time, supply outweighs demand, and price movement displays lower highs and lower lows. And thirdly, it's a sideways or neutral bias. There is no repeating pattern and supply and demand are in balance. In the markets, there are a lot of strategies available to trade these different biases. For example, a neutral bias is great for cash flow strategies. In this video, we will concentrate on the most basic task, which is to determine the predominant trend direction of the market and the likely movement of share prices. Next, we need a ranking system. A ranking is a relationship between a set of items such as different shares. For any two shares, the first share is either ranked higher, ranked lower, or ranked equal to the second share. This will refine your bias. In breaking down the market bias, we look at a number system between -3 and +3. The larger the number, either positive or negative, the more aggressive your bias is. So if you believe the share is going to skyrocket to the upside, you would rank your bias at +2 or +3. If you're bullish, but believe the trend is casual, consistent, and nothing extraordinary, you might rate your bias +1. If you're aggressively bearish, you would give your market bias a -3 or -2. If you believe the share is bearish, but only slightly or consistently selling off, then a ranking of -1 would make sense. If you're neutral, your ranking would be 0. Using a ranking system like this will define your universe more precisely. The top-down approach to the financial markets is a technique that traders can use to determine a number of different things that are vital to the health and stability of your trading portfolio. Remember, the portfolio is always more important than the individual trade. Sometimes we get so caught up in one trade that we lose sight of the overall goal of what we're trying to accomplish in terms of controlling and managing our money. The top-down approach is a method used to analyze and choose shares. This term is also used in many other areas of business, finance, investing, and economics, and many traders get them confused or don't fully understand the approach. A top-down approach moves from the general to the specific and uses comprehensive factors as a basis for decision-making. The top-down approach seeks to identify the big picture and all of its components. These components are usually the driving force behind market trends. Top-down is commonly associated with the word macro or macroeconomics. Macroeconomics is an area of economics that looks at the biggest factors affecting the economy as a whole. These factors often include things like the interest rates, unemployment rates, global and country-specific gross domestic product, and inflation rates. A trader seeking a top-down perspective wants to look at how systemic factors affect an outcome. They are seeking to understand how the big picture trends are affecting the entire industry. We are now going to highlight using sectors and sector rotation as a building block to your trader's toolkit. Let's start by defining what is a sector, as defined in the financial markets. Sectors are divisions within an economy or market useful for analyzing performance or comparing companies with similar outputs and characteristics. Many traders believe it is risky to focus trading too heavily on a single sector. The strategy of trading across sectors in different areas of an economy is called diversification and is a way of mitigating risk in your portfolio. Companies are also categorized into sectors such as oil and gas, technology, utilities, or healthcare. To improve your trading decisions, you want to determine where other traders and investors are allocating money. This is important because when money is allocated to a sector, there will be an appreciation or increase in the value of the sector. Sector rotation refers to taking money that's invested in one part of the equity market sector and moving it to another. To do this, you simply sell shares in one sector and then use those proceeds to invest into another. This may allow you to capitalize on a change in economic conditions and earn higher returns. Because it involves hands-on management of your trading account, sector rotation is a type of active trading strategy. This is in contrast to so-called passive trading strategies that involve buying a share and holding onto it for a long period of time. Because some sectors are inherently more sensitive to traders and investor sentiment than others, rotating money in or out of equities or funds that track these sectors could result in higher returns. Sector rotation strategies can be as simple or as complex as traders make them. On a very simple level, you can enact sector rotation in your trading portfolio by moving among two main categories of shares, cyclical and defensive. Cyclical sectors refer to the types of companies where consumers make discretionary spending decisions, like retailers, restaurants, or technology providers. These industries historically outperform the market when the economy is expanding and consumers and businesses have greater demand for related products or services. Defensive or non-cyclical shares refer to the types of companies where there is a steady demand, even during periods of economic weakness, because they offer necessary products or services. Examples include utilities, healthcare, and consumer staples like food producers or distributors. One common sector rotation strategy is to rotate out of defensive shares and into cyclical shares when you believe the economy is poised for growth. By contrast, if you believe the economic growth will slow, you may want to increase the exposure to defensive shares in your portfolio. It doesn't help if you have a market opinion that you enhance with a ranking system to express your view if you do not follow it. Nor does a top-down analysis approach that is supported by sector rotation to mimic the flow of money help if you do not have a plan to support it. Like a good coach in a rugby game, traders should prepare for the game of trading. This game can be cutthroat, nasty, brutish, and you should be ready to play rough. It's also a game that you should absolutely love, and one that if you prepare like a good coach, you will be successful in playing. When you have a game plan, it allows you to get in and out of the market in a non-emotional way. So often, we see traders jump into markets based on emotion, investment show ideas, or rumors. This is the worst possible way to trade and the quickest way to lose money. A game plan is a systemic method for identifying and trading shares that takes into consideration a number of variables including time, risk, and the trader's objectives. A game plan is a researched and written document that guides a trader's decisions. It defines your trading behavior, including but not limited to your financial goals, money management rules, risk management techniques, and criteria for opening and closing positions. Many of us in our everyday life start out with a plan of sorts, our personal priorities, which help us achieve our definition of success. In trading, your personal decisions translate into either a profit or a loss, and knowing your trading direction could be that fine line between success and failure. If you do not have a game plan, then you have planned to fail. We can't emphasize enough how important it is to have a game plan. Entering the trading realm can be daunting. At some point, as a trader, you will lose money as you engage in the buying and selling activity while the markets make their move. However, planning your trades will reduce the risk of depleting your trading capital. The first part of your plan is personal analysis. Ensure you're ready to trade and that you're willing to follow your analysis without hesitation. Find out what your strengths and weaknesses are prior to entering the trade. You then need to set your trading goals. Start off by writing out your trading objectives and setting realistic goals. Look at and assess your financial goals and the time frames for reaching each trading goal, and ensure that when you have made a successful trade, you will close the position. Don't get greedy. Then identify your market and trading timeframes. Select your trading and market according to your knowledge and expertise. The best market for you is the one you are familiar with. There's no sense in entering a trade in a foreign market that you have no knowledge about and expect it will be profitable. In addition, you need to ensure that you're aware of each market's trading session hours. Attention needs to be given to trades at the important trading times. And very importantly, know upfront what you are willing to risk. Every time you open a position or fund your trading account, be sure to enter an amount that will be the maximum amount that you are willing to risk. It's very important not to get emotionally wrapped up in the trades. Fund the account and stick to the initial plan. Control your finances by means of money management. Then decide when to open the position and in what direction, buy or sell. This can be determined by analyzing charts or reading up on the latest market analysis. You then need to specify your entry and exit points. This means you must set your stop losses and profit targets while providing room for adjustments but not getting emotionally absorbed by your trading. And lastly, manage your trading emotions. Don't let your feelings cloud your judgment and treat your trading like a business. Lastly, we need to emphasize the importance of having a winning trading mindset. Winning traders don't necessarily have better formulated trading strategies. They may not be smarter than other traders, and they may not do better market analysis. Even with all these tools in place, a trader can still lose money. What separates a winning trader from a losing trader is their psychological mindset. There are plenty of traders who use intelligent, well-designed trading strategies and systems who still regularly lose money. The few traders who do consistently win the game of trading are those who, in addition to using the right tools and strategies, have also developed the appropriate psychological mindset that enables them to be consistent winners. They all display a positive outlook on life. Here are a few pointers to developing a winning trading mindset. Focus on the good things. Challenging situations and obstacles are a part of life. When you're faced with one, focus on the positive aspects, no matter how small or seemingly insignificant they seem. Create a ritual in which you start off each day with something uplifting and positive. Practice gratitude. Practicing gratitude reduces stress, improves self-esteem, and fosters resilience even in very difficult times. Open yourself up to humor. Laughter lowers stress, anxiety, and depression. It also improves coping skills, mood, and self-esteem. Spend time with positive people. Negativity and positivity are contagious. Consider the people with whom you're spending time and whether they are leaving you in a positive or a negative mood. Identify your areas of negativity. Take a good look at the different areas of your life and identify the ones in which you tend to be most negative. If you're not sure, ask a trusted friend or colleague. Practice positive self-talk. We tend to be hardest on ourselves and are often our own worst critics. Over time, this can cause you to form a negative opinion of yourself that can be hard to shake. Be mindful of the voice in your head and consciously choose positive messages for yourself. Now let's bring it all together. Nothing guarantees success in trading, but using a toolkit can help you avoid failure and put you on the road to a more successful trading career. Your trader's toolkit consists of the analysis you do, your interpretation of the data, and the game plan you formulate. First, conduct your broad market analysis. Look at all the key index charts, sector charts, and other indicators available to you. Then give your final rating for the period you're reviewing. What is your market bias? What is your ranking? Now decide what this means for your trading portfolio. What is your game plan for this trading period? Having a game plan eliminates some of the roadblocks to success. It makes it easier to not just place winning trades, but to hone your trading skills over time so that you become increasingly successful the longer you trade. We have reached the end of this video. This educational session was brought to you by Nedbank Online Share Trading. Any examples used in this session are purely for illustrative purposes. Thank you for your time.